Welcome to the weekly market recap with SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. In a recent analysis, the Central Bank of Sri Lanka reports a notable improvement in the health of the country's banking sector. Non-performing loans have fallen to 11.9% of total gross loans by the end of the second quarter of 2025, down from 12.7% recorded in the first quarter. In absolute terms, gross NPLs dropped slightly to 1,464 billion rupees compared to 1,474 billion rupees 3 months earlier. At the same time, profitability showed strong momentum. Net interest income more than doubled to 501.1 billion rupees, while pre-tax profits surged to 291.2 billion rupees, up from 146.6 billion rupees in the first quarter. After-tax profits also nearly doubled, reaching 187.8 billion rupees. The central bank noted that this performance reflects a steady recovery from what has been described as the worst currency crisis in the country's history. A crisis driven by aggressive rate cuts and liquidity injections that ultimately led to a sovereign default. Importantly, the report highlighted that Sri Lanka's recovery was aided by the government's decision not to default on domestic debt, a move that helped safeguard bank capital and rebuild confidence in government securities. The central bank also underscored the impact of its deflationary monetary policy, which has contributed to a gradual easing of interest rates, further stabilizing the financial sector. According to the latest data from the central bank, Sri Lanka's foreign reserves stood at $6.24 billion in September 2025, marking a modest increase of $77 million from the previous month. However, the figures also show that reserves have remained largely unchanged for the past 11 months, indicating a period of stagnation. Reserves had previously peaked at $6.47 billion in October 2024, but since then, growth has not resumed. Economic analysts note that net reserves have improved as the central bank has used monthly collections to settle past reserve-related liabilities, obligations that had previously been incurred during efforts to control interest rates and stabilize the currency. The analysis further suggests that the central bank appears to have paused its inflationary open market operations, reducing the immediate risk of a policy-related default. In September, the central bank reportedly collected $177 million, signaling upward pressure on the rupee, likely stemming from a mild tightening of monetary conditions. However, experts point out that the current IMF program does not require the central bank to sell down its domestic asset holdings, a step considered essential for building reserves sustainably. While the bank may be able to meet the IMF's net international reserve targets, analysts remain cautious about the feasibility of reaching the projected $7 billion gross reserve level. Commenting on future policy, analysts such as Bellwether suggest that the next IMF program may need to include a clause compelling the central bank to reduce its domestic asset stock to strengthen reserve accumulation. Meanwhile, concerns persist over limited parliamentary oversight of the central bank's operations and the gradual depreciation of the rupee, despite strong current account surpluses, challenging traditional views on the causes of currency weaknesses. In a key development for Sri Lanka's economic recovery, the International Monetary Fund and the Sri Lankan authorities have reached a staff-level agreement on economic policies under the fifth review of the Extended Fund Facility Program. According to the IMF, once this agreement receives executive board approval, Sri Lanka will gain access to around $347 million in new financing. An IMF mission visited the country from September 24th to October 9th to review recent macroeconomic trends and assess progress under the ongoing reform program. The extended fund facility, valued at special drawing rights of $2.3 billion, approximately $3 billion, was initially approved in March 2023. IMF officials noted that Sri Lanka's economic reforms continue to show positive results, with inflation stabilizing, foreign reserves strengthening, and economic growth outperforming expectations. The economy expanded by 4.8% year-on-year during the first half of 2025, while inflation rose only slightly by 1.5% in September, reflecting gradual stability. Meanwhile, gross official reserves reached $6.1 billion by the end of September, supported by stronger revenue collection, particularly from motor vehicle import taxes. Debt restructuring, a central component of the IMF program, is said to be nearing completion. The IMF delegation highlighted that program performance remains strong, backed by robust fiscal revenue and improved external resilience. The mission also emphasized the importance of sustaining reform momentum to maintain macroeconomic stability and strengthen Sri Lanka's ability to withstand future shocks. However, the IMF noted that the staff-level agreement will only move to board approval once Parliament passes the 2026 appropriation bill and assurances from financing partners are confirmed. Upon completion of this review, Sri Lanka's total disbursement under the program will reach approximately $2.04 billion. According to the Central Bank's Financial Stability Review 2025, Sri Lanka's finance companies recorded a strong expansion in credit during the first half of the year, mainly supported by vehicle and gold-backed lending. The report attributes this surge to the lifting of restrictions on vehicle imports as well as the impact of rising gold prices and declining market interest rates. However, the central bank cautioned that this growth has led to a high concentration of lending in a few asset categories, increasing potential collateral risks within the sector. Reflecting the sector's rapid expansion, the Stage 3 loans ratio, a measure of non-performing loans, declined significantly by the end of June 2025 compared to the same period a year earlier. Despite this improvement, liquid assets of finance companies have been declining for 4 consecutive quarters on a year-on-year basis. Still, the central bank confirmed that liquidity levels remain comfortably above regulatory requirements. The review also revealed that profitability improved, supported by high net interest income during the period. Meanwhile, the sector's capital adequacy ratio stayed well above minimum regulatory levels, though it edged down slightly as risk-weighted assets increased alongside credit growth. The central bank concluded that these trends demonstrate the sector's resilience, strong credit momentum, and its ability to maintain capital and liquidity buffers, even with a lending portfolio heavily weighted towards vehicle and gold-backed loans. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.52%, down by 1 basis point, and the 182-day T-bill rate stands at 7.89%, and the 1-year T-bill rate stands at 8.02%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.